In 2025, the U.S. Securities and Exchange Commission (SEC) introduced several major regulatory changes that every investor must understand to navigate the markets effectively. The SEC's mission is to protect investors, maintain fair and efficient markets, and facilitate capital formation. In an era of evolving technologies, climate concerns, and increasing market complexities, the 2025 updates reflect a new emphasis on transparency, sustainability, cybersecurity, and investor empowerment. Whether you're a seasoned investor, a financial advisor, or a newcomer to the markets, staying informed about these new SEC rules is crucial for making sound investment decisions and avoiding potential legal pitfalls. Below, we dive into the top 10 new SEC rules that investors must know about this year. 1. Enhanced climate risk disclosure requirements. One of the most anticipated changes in 2025 is the SEC's new rule mandating public companies to provide detailed disclosures about their climate-related risks and greenhouse gas emissions. Companies must now explain how climate change affects their operations, financial performance, and long-term strategies. They are also required to provide Scope 1, Scope 2, and in some cases, Scope 3 emissions data. For investors, this means greater transparency into how companies are managing environmental risks, offering new ways to evaluate long-term sustainability and resilience when choosing investments. 2. Expanded cybersecurity risk reporting. Recognizing the growing threat of cyberattacks, the SEC now requires companies to report cybersecurity incidents within 4 business days of determining material impact. Companies must also disclose their cybersecurity risk management policies, governance structures, and history of prior breaches. For investors, this new rule means more immediate access to critical information about a company's vulnerability to cyber risks, enabling better risk assessments and portfolio management strategies in an increasingly digitalized economy. 3. Shortened settlement cycle, T+1 rule. In a significant move aimed at reducing counterparty risk and enhancing market liquidity, the SEC finalized the transition from a T+2, trade date plus 2 days, settlement cycle to T+1, trade date plus 1 day. This means that securities transactions will now settle 1 day after execution, requiring investors and brokerage firms to fund trades more quickly. Investors must be prepared for faster cash movements and ensure that their financial institutions are equipped to meet the shortened deadlines, especially when engaging in frequent trading strategies. 4. Mandatory human capital disclosures. Building on earlier guidance, the SEC now requires companies to disclose detailed information about their workforce, including metrics such as turnover rates, diversity statistics, training programs, compensation practices, and workplace safety initiatives. This shift acknowledges the growing investor interest in environmental, social, and governance (ESG) factors. Investors can now assess not just a company's financial metrics but also how it manages its most valuable resource, its people, when making investment decisions. 5. Revised private fund transparency rules. Private equity funds, hedge funds, and other private investment vehicles are now subject to heightened reporting requirements under the SEC's 2025 rules. These funds must provide standardized quarterly statements disclosing fees, expenses, fund performance, and conflicts of interest. Additionally, certain fund advisors are required to obtain annual audits and fairness opinions for specific transactions. For investors, this dramatically increases transparency in private markets, enabling more informed investment into previously opaque asset classes. 6. Stricter regulations on crypto assets. The SEC has officially expanded its regulatory framework for crypto assets and decentralized finance (DeFi) platforms in 2025. Issuers of digital tokens that resemble securities must now register with the SEC and provide full disclosure statements. Crypto trading platforms must comply with new exchange registration requirements. Investors venturing into digital assets will benefit from stronger protections but must also ensure that the platforms and projects they interact with are compliant with these heightened regulations to avoid legal and financial risks. 7. New standards for ESG fund naming and marketing. To combat greenwashing, the SEC now enforces stricter naming and marketing rules for funds that advertise themselves as ESG-focused. Funds must invest at least 80% of their assets in investments aligned with the ESG terms used in their names. Marketing materials must include clear, standardized disclosures about ESG investment processes and criteria. This rule ensures that when investors choose funds based on environmental or social priorities, they are truly getting what is advertised rather than being misled by vague claims. 8. Strengthened shareholder proposal rules. Investors seeking to submit shareholder proposals now face updated thresholds under the SEC 2025 amendments. While the rules aim to balance access with efficiency, shareholders must demonstrate a longer holding period and a slightly higher ownership percentage to submit proposals. However, the thresholds are designed to ensure that proposals come from investors with a genuine long-term interest in the company. For active shareholders, understanding the new filing requirements is essential to engaging effectively in corporate governance activities. 9. Enhanced investment advisor marketing rule enforcement. The SEC has increased enforcement of its updated marketing rule for investment advisors, originally introduced in late 2020 and refined in 2025. Advisors must now adhere to strict standards around testimonials, endorsements, performance advertising, and hypothetical performance presentations. Investors should be aware that advertisements must now meet rigorous substantiation requirements, providing greater confidence in the promotional claims made by financial advisors and asset managers in the marketplace. 10. Increased focus on artificial intelligence, AI, disclosures. Recognizing the growing role of AI in trading, asset management, and financial analysis, the SEC now requires firms using AI algorithms to disclose their use and any material risks involved. Firms must explain how they oversee AI systems, prevent algorithmic bias, and ensure fairness and transparency in customer interactions. Investors should look carefully at these disclosures, especially when considering investments in firms heavily reliant on AI, to understand both the opportunities and risks associated with these powerful technologies. Debt, when used wisely, can be an incredibly powerful tool for personal and financial growth, but when mismanaged, it can become a serious obstacle. Knowing the big differences between good and bad debt empowers you to make smart borrowing decisions, prioritize investments that build your future, and avoid financial traps that could derail your progress. Good debt helps you grow wealth, manage cash flow, build credit, and create new opportunities, whether it's through education, real estate, or entrepreneurial ventures. Bad debt, on the other hand, often results from impulsive decisions, finances depreciating assets, carries high interest burdens, and limits your financial freedom. Recognizing the purpose, cost, impact, and long-term effect of each type of debt allows you to approach borrowing thoughtfully and strategically. By favoring good debt and steering clear of bad debt, you set yourself on a path toward greater financial resilience, flexibility, and prosperity, making debt a stepping stone to success, rather than a stumbling block.